Welcome back to Investor Hub X. In the previous lesson, we learned how to identify and draw strong support and resistance levels directly on the chart. In this video, we're going to take that skill one level higher. We're going to talk about key support and resistance levels on the higher time frame and why these levels matter more than almost anything else you'll see on a chart. If you understand this concept, you'll stop reacting to noise. Let's get started. First, let's define what we mean by a higher time frame. A higher time frame usually means the weekly or monthly chart. Each candle on a monthly chart represents 1 month, while each candle on a weekly chart represents 1 week. Higher time frames show the big picture: major trends, key turning points, and important price zones that institutions pay attention to. What happens on a higher time frame carries more weight. Support and resistance levels on higher time frames are usually higher quality, and we call these key levels. There is a higher chance that traders will take action when price reaches a key level. Let's now go through step by step how to draw them. Step 1. Always start from the highest time frame relevant to your trading. To move to a higher time frame, there are 2 simple methods. First, you can click the time frame selector at the top of the chart and choose the time frame you want. Alternatively, you can use the keyboard. For example, if you want to switch to the 1-week time frame, type 1W. If you want to switch to the monthly time frame, type 1M. Using shortcuts like this makes it much faster to move between time frames when you're analyzing the market. Step 2. Look for major swing highs and swing lows. Step 3. Focus on areas where price has reacted multiple times, not just once. And remember, these are zones, not precise lines. We're marking areas of interest, not exact prices. Now here's where everything comes together. Let's look at the Bitcoin chart. On your keyboard, press 1M to switch to the monthly time frame. On the monthly chart, we're looking for the most important levels, areas where price made major decisions in the past. Right here is a clear example of previous resistance turning into new support. You can see strong swing highs and swing lows in this area, followed by a very decisive move away from the level. When price moves away this aggressively, it tells us this level was important. And that's what makes it a key level. Here's another area to pay attention to. Notice how price was rejected multiple times around the same zone. Again, we see clear swing highs and swing lows, and a sharp reaction away from the level. Multiple rejections combined with a strong move make this an obvious level to watch. Moving on, this is another key area on the monthly chart. Price reacted here repeatedly, forming several swing highs and swing lows before making a strong move. This tells us that buyers and sellers were actively defending this level over time. And finally, here's one more obvious level worth marking. Once again, we see multiple rejections in the same area, followed by a decisive move. This is why higher time frame levels are so well respected. They're formed over long periods of time and reflect real market participation. These are high-quality levels, and they deserve our attention. Next, change to weekly time frame. Higher time frame levels should be very obvious. You'll often find some levels visible on the weekly that are not visible on the daily. Similarly, some levels on the monthly won't appear clearly on the weekly. We're not ignoring the daily or lower time frames. We're simply giving more importance to the higher ones. After drawing monthly and weekly levels, you can drop down to the daily to refine them if needed. Notice how clear these levels are on the higher time frame. This helps remove noise and keeps our focus on the key levels that matter most. Just a reminder, we don't enter trades based on support and resistance alone. We still need price action for confirmation. Now that you've seen how to draw key levels, it's important to talk about what not to do. Most mistakes with support and resistance don't come from drawing levels incorrectly. They come from focusing on the wrong time frame. Here are a few common mistakes to avoid. Number 1. Drawing too many levels on lower time frames while ignoring higher time frame structure. Number 2. Treating higher time frame levels as exact prices instead of zones. And number 3. Entering trades without knowing where the nearest higher time frame support or resistance is. Fixing these mistakes alone can dramatically improve your trading clarity. To summarize, higher time frame support and resistance levels define the battlefield. Lower time frames simply show how price behaves within that structure. Once you understand this relationship, the market starts to make much more sense. Structure first, entries second. I'll see you in the next video.